on an even bigger limb, Shane, and target a physically driven gold price that not just reaffirms our 1st of January estimation of a minimum of $4,000 per ounce by the end of the year 2025. Because why? Because we see the PBOC active, and it's now bringing the bullion banks in to understand how they can quantify supply demand. I figure now that is too conservative. And what we're going to do is we're going to look at every single reason. We'll look at every reason that gold is going to 4,500.
So let's step through this. On the 1st of March of 2024, the PBOC opened up the Shanghai Futures Exchange, and that was gold trading, enabling gold trading to be accessed by commercial and private citizens. And as we've tracked every month since then, it was clear that this was an official strategy to drive massive gold investments into China. And from the open of the 1st of March 2024, this launch, into the end of the year, and this is the 31st of December of 2024. So into the end of the year, we evidenced gold rising by an unprecedented $760. And then we saw that initially here, and we saw a little bit, but then we saw a little bit of a pullback into the end of the year. Essentially, this is also, and this is why we have a note here, this is where repatriation also commenced. And that was as soon as it was known that Trump was going to take the helm. And suddenly we had the realization that there was going to be audits and one thing and another. So, we're covering several things here. But essentially, we're really looking at this China investment. So the reason we're looking at it now, and despite the end of the year rinse, which we saw, it still ended up closing, physical gold still ended up closing $620 higher than the strategic Shanghai Futures Exchange launch. The reason we're talking about it here, by no coincidence, 1 year later, and we're looking at this now, in the early stages of the second quarter of 2025, we're witnessing a similar officially sanctioned, commercially targeted gold buying mandate being sprung on the West, driven by a directive for Chinese insurance companies to invest 1% of their assets into physical gold. And as we drew attention to in our last episode, it will require an even larger percentage of available gold mine supply to be drawn down into China by the fourth quarter of 2025. And this kind of leads us to some targets. Now, these were originally, if you remember, we had all of these circled in previous episodes, 3,000, 3,100, 3,200, etc. And we've had to move the Basel III from 3,300 to 3,500. And we'll go through why in a minute. And we'll go through what all of this means. Now, this is the spot gold chart, not the futures charts. So, and again, also the spot chart here on a daily basis. Now, as we will look at shortly, the current PBOC mandate will easily match, if not surpass, a similar $800 higher price than was benchmarked at the end of the first quarter. And that was benchmarked at where the BIS, where the Fed BIS squared their BIS borrowed swaps at spot 3,100. And as we will look at, these higher price estimates are quantifiable. The latest PBOC mandate alone conservatively puts the Chinese driven gold price at 3,900, and that is conservative. In fact, all the Western bullion banks have woken up to quantifiable supply-demand metrics that price gold around these levels or higher. When I say these levels, I mean $800 higher than 3,100. Also, every ounce of gold that enters China stays in China and by proxy is collectively owned by the state, so can be easily accessed in times of war. And we've already previously looked at how 25,000 tons of citizens' gold could be patriotically leased from citizens by the state in a time of war. And while we read this as a military war, there is no reason why it could not be accessed in a financial war, which, we're looking at that being foreshadowed right now. Furthermore, it's no secret that Beijing's monetary gold purchases have not yet been counted as official reserves, which, when aggregated with what is salted amongst the state-held banks and very large 400-ounce gold held by the generals, is far closer to 40,000 tons. And that's in addition to what is held by citizens. If and when it suits Beijing to reveal these true reserves, I don't want to digress, so we will look at how linked with Russian reserves, these gold reserves will ultimately widen the scope of digital RMB, and we'll look at that shortly. But bottom line, the major bullion banks are aware gold that enters China does not return, which is why the bullion banks have woken up to looking at quantifiable supply and demand metrics that value gold between $500 and $1,200 higher. And we're going to look at where Goldman has brought forward what was originally expressed as a tail risk of 4,500 as being brought potentially forward to the end of 2025.
Let's start where this all began on March 1st, 2024, when the People's Bank of China quietly opened the Shanghai Futures Exchange to commercial and retail gold investors. That, my friends, was the starting gun. That was the PBOX signaling. We're not playing in the Western paper game anymore. We're creating our own price discovery mechanism, and this one actually settles in physical. From that moment, we tracked the move. We watched the flows. We saw how gold rose an unprecedented $760 from March to December. And that wasn't a market reacting emotionally. That was a nation, China, executing a coordinated gold acquisition strategy that involved commercial banks, insurance companies, and private citizens. But here's the kicker. Despite a brief end-of-year pullback, the physical market closed $620 higher than it was when the Shanghai Exchange opened. And that was before the next leg began. Because now, in 2025, we're seeing a second, even more aggressive phase of this campaign. Just recently, the PBOC issued a mandate that Chinese insurance companies must invest 1% of their assets into physical gold. And just so we're clear, we're not talking about ETFs, not futures, not options. We're talking deliverable vaulted physical bullion. Do you understand the magnitude of that? We're talking about an allocation so massive, it will consume a material percentage of the entire global mine supply, especially when you consider this gold doesn't come back out. Gold that goes into China stays in China. It's stored by banks, state institutions, or in the hands of citizens. And in China, that means it's accessible by the state at any moment. Now, don't gloss over that. Every ounce of gold that enters China is tracked. It's not coming back. And in the event of war, whether that be military or financial, it can be reclaimed patriotically. Beijing already has protocols in place that allow it to lease citizen gold back to the state if needed. We've discussed before how this could apply to the 25,000 tons believed to be privately held. But let's talk about the real number, because here's where things get explosive. The official PBOC reserve numbers, the ones they report to the IMF, are still incredibly conservative. But based on tracking imports, bullion bank flows, and commercial vault deliveries, we estimate China is sitting on close to 40,000 tons of unreported gold. Let me say that again, 40,000 tons. That includes what's held in state-run banks, what's stored by the military in 400-ounce good delivery bars, and what's salted throughout local financial institutions under non-reserve classifications. This is gold not yet declared, but which exists, and can be revealed at a politically convenient moment. Now ask yourself, what happens if China were to officially acknowledge even half of this? What if they come out tomorrow and say, by the way, we're sitting on 30,000 tons, not 2,300 like we told the world? What happens to the credibility of the U.S. Treasury market? What happens to the dollar? The answer is simple. Confidence evaporates. The gold price reprices overnight. And that's not theory. That's already being modeled. Let's talk about what the bullion banks are saying now. Goldman Sachs, JP Morgan, UBS. They're not stupid. For years, they treated $4,500 gold as a tail risk, a far-off possibility. But now, Goldman has moved that target forward. They're saying it could be in play by the end of 2025. Why? Because the math is finally undeniable. Western institutions are waking up to actual supply and demand mechanics. They're realizing that their models, based on leveraged futures, central bank dishoarding, and non-deliverable derivatives, are broken. In fact, we're now seeing major desk-level recalibrations. Pricing desks are admitting that based on current demand flows, constrained mine supply, and non-recyclable sovereign hoarding, the true equilibrium price of gold is $800 to $1,200 higher than where it is now. And that's conservative. Remember, every ounce of gold entering China is permanently removed from global liquidity. It's like pouring water into a black hole. And the West? The West is just now realizing they're being priced out of their own game. Let me put it bluntly. China is building a monetary gold standard without declaring it. It's gold by proxy, a financial nuclear arsenal that doesn't need to be fired, only acknowledged. Now, combine that with the increasing tension around reserve currency status. The BRICS are expanding. The Saudis are selling oil in yuan. Russia is selling commodities in rubles. Trade settlement outside the dollar is accelerating. And what do these nations have in common? They're all accumulating gold. You think that's coincidence? Let me bring you back to the BIS, the so-called central bank of central banks. We now know the BIS squared their gold swaps at $3,100 per ounce. That's right, central bank level transactions are settling at prices above COMEX spot. And that's critical. It shows you the real price of gold isn't what's printed on your screen. It's what sovereigns are actually paying. So what does this mean for the retail investor? It means you've got a very narrow window to front-run an institutional repricing. It means the days of cheap, available bullion are numbered, and it means you'd better stop thinking of gold as a hedge and start thinking of it as a foundation. Because the repricing isn't coming, it's already started.
An unfactored drain on demand, and it's not going unnoticed by these extremely well-connected bullion banks who, having filled their boots long before publicly raising their gold price targets, they're now doing so on a weekly and now on a daily basis, alongside end of first quarter higher gold price estimates from several bullion banks. That was JP Morgan, UBS, Deutsche Bank, Citi, and most notably Goldman Sachs, who reaffirmed tail risks of a $4,500 gold price in 2026, possibly being brought forward to 2025. It's these factors that are making them take notice. It's notable that these 2025 targets, which our first-tier liquidity providers, including Goldman Sachs, have been sharing with us here since January, they're now being openly shared publicly. Why? Because they filled their boots already. And we know these bullion banks have been long and strong for their own books since the Bank of International Settlements short-covered all their swaps and leases on the 1st of November 2022. And these banks have now stepped up accumulating gold for both their house and their client accounts ahead of US Basel III compliance on the 1st of July. And these repatriations have to be concluded before the end of this second quarter because there's going to be an audit. Now, please also remember, through all of this, we've been reporting very, and I mean very in capitals, large official size Indian and Chinese demand over the last few weeks that have preceded all of these price upgrades. Now, with the cat out of the bag, Chinese institutional demand, which has been waiting for an end of the month, end of quarter pullback, they took everything on offer into that dip. And following unprecedented tariff escalations this week, leaching into a financial war, China has stepped up selling dollars, treasuries for gold. This includes as yet untapped pension fund demand, which we refer to, which liquidity providers had already reported began picking up on the 1st of April. Well, we're only on the 16th here now. This was noted by Bloomberg here in this link. In addition to the pension fund gold buying mandate, the PBOC has also allocated fresh gold import quotas to commercial banks to meet increased demand from institutional and retail investors amid escalating trade war. And I mean, a quote from them, this is what they said: to meet significantly increased appetite. This flies in the face of some Western report of a lack of investor and jewelry demand due to higher prices.
Let's pick right back up, because this story isn't easing off. It's accelerating. The repricing of gold is not theoretical anymore. It's happening in real time, driven by China's aggressive accumulation strategies, and now visibly affecting how bullion banks, sovereign players, and even Western policymakers model risk. Gold isn't just a metal anymore. at least not to those who understand the implications of what's been set in motion. It's become a geopolitical lever, a monetary compass, and a weapon in a war that's being waged not with tanks or missiles, but with trust, capital flows, and reserve balances. And the West? Well, the West has barely even begun to realize it's already on the back foot. As I said before, the moment the Shanghai Futures Exchange was opened up to commercial and retail gold investors on March 1st, 2024, the world quietly stepped into a new monetary era. It was the PBOC essentially saying, we will no longer accept Western price discovery as legitimate. We are creating our own benchmark, one that settles in physical, not paper IOUs. From that moment, flows into China ramped up massively. And what followed wasn't just a bump in the market. It was a structural shift in how gold would be acquired, traded, and stored going forward. Over the course of 2024, we witnessed gold climb $760 per ounce, despite a short-term year-end rinse. The bigger story wasn't the volatility, it was the base it established. Physical gold closed $620 higher by year's end, and that happened in a global environment where mainstream media barely blinked. But we're now into the second quarter of 2025, and what's playing out is a whole new level. The PBOC's latest move, compelling Chinese insurance companies to allocate 1% of their assets into physical gold, is an act of strategic statecraft. Think about that. This isn't speculation. This is a mandated structural reallocation of domestic capital into bullion, real metal, deliverable metal, metal that will be vaulted and never see the light of day again. When we calculated the scale of such a reallocation, the figures were stunning. The insurance sector in China controls trillions of dollars. Just 1% of that directed into physical gold translates into a drawdown that could absorb the majority of global mine supply by Q4 of this year. Now the Western markets are finally and somewhat sheepishly catching on. Goldman Sachs has quietly upgraded their gold target. Again, now openly acknowledging that the previously unthinkable $4,500 per ounce level might not just be reachable in a few years, but is a plausible target by the end of 2025. This isn't based on hype. It's based on real-world, real asset flows. They are now modeling physical supply and demand instead of leveraging derivatives and futures premiums. Why the sudden shift? Because they're being forced to. The old model, where Western institutions dictated price through paper contracts 100 times the size of available metal, can no longer contain the reality that physical demand, especially from Asia, is completely decoupled from the fantasy world of COMEX and LBMA. Let's talk about those markets for a moment. We now know that the BIS squared their gold swaps at $3,100 per ounce, a number that sent shockwaves through institutional pricing desks. That means central banks are transacting at prices far above spot. It means the central banks themselves are admitting that COMEX is irrelevant, that the real price of gold, the one that matters, is already hundreds of dollars higher than what the Western financial press is reporting. And what's really important is that this is not just a pricing anomaly. It's a reflection of a collapsing trust structure in the Western monetary regime. This is what a financial war looks like. A slow and deliberate reordering of the global reserve structure through bullion, not bombs. China is playing a game of silent conquest. Every ounce of gold they acquire becomes a tool of monetary insulation. It removes exposure to dollar volatility. It increases domestic financial resilience, and it lays the foundation for a future where the yuan can function, even partially, as a trusted medium for trade settlement. And they're not doing it alone. Russia is matching this move. Despite sanctions, they've converted a significant portion of their trade surplus into gold. We now have credible sources confirming that they are adding both to their reported reserves and to off-the-books strategic holdings. What's more, both nations are conducting bilateral trade in rubles, yuan, and gold-backed mechanisms, cutting the dollar out of the equation entirely. What this creates is a bifurcation of the monetary system. On one side, you have the dollar-centric West, increasingly reliant on paper markets, debt monetization, and a collapsing bond confidence. On the other, you have a growing block of nations reconfiguring around hard money. And the foundation of that hard money is gold, physical gold that doesn't move, doesn't default, and doesn't lie. Now let's come back to the price. Based on current flows, known repatriation demands, commercial purchases, and the state mandate-driven drawdown into China, the quantifiable equilibrium price of gold, where actual supply meets sovereign demand, is somewhere around $3,900. That's conservative. When you add in the speculative momentum, the unwind of Western shorts, and the eventual flood of Western retail investors catching on, the price overshoots. It doesn't drift, it jumps. That's how we get to $4,500. That's why it's not a fantasy figure anymore. It's a benchmark in waiting. And remember, none of this includes what happens when the average person starts paying attention. Right now, retail exposure to precious metals in the United States is still under 0.5%. That's nothing. That's statistical noise. And yet we're already seeing the cracks. Dealers reporting weeks-long delivery windows, physical premiums climbing, allocation caps being discussed behind the scenes. The moment the masses wake up and say, wait a minute, why is gold at $3,800 and I can't get any? The window slams shut. At that point, the market bifurcates. Paper gold becomes one price, and real gold becomes another. COMEX loses credibility. LBMA becomes a formality. And pricing is dictated not by leverage, but by delivery. If you think that's far-fetched, ask yourself this. Would you accept a gold IOU from a Western bank if the entire system is unraveling? Or would you want the metal in your hand, stored, vaulted, insured, and accounted for? And while all of this is playing out, Western central banks will be forced into a corner. They'll either have to admit they have far less gold than they claim, or they'll have to reprice it to rebalance their balance sheets. That's how gold returns to the monetary system, not through some formal Bretton Woods 2.0 declaration, but through market-driven necessity. And in that world, the gold price doesn't just rise, it re-anchors global value. So what does this mean for you? It means the time to act is now, not tomorrow, not when your favorite influencer says gold just made a new high. By then, it's too late. By then, the physical will be gone, the premiums will be unsustainable, and the institutional players will have already positioned. You have to front-run this repricing the same way China is doing, with physical ounces, with long-term custody, with secure, sovereign, insulated allocations. Because once the realization sets in that the dollar is being challenged, not through confrontation but through gold, you'll understand why gold isn't rising. The dollar is falling, and gold is just standing still, doing what it's always done, measuring the truth. That's where we are right now. In the early stages of a financial reset that the media refuses to report, but the smartest money on the planet has already priced in. And the next leg higher? It won't be linear. It'll be explosive. Because when the last ounce leaves the vaults, when the last trader closes their paper short, and when the last central bank admits they were wrong, that's when gold will show you its true value. And it won't be $3,500 or $3,900. It'll be something you can't even model with old frameworks. So don't wait for the shock. Prepare now. Because gold isn't going higher. Everything else is just collapsing around it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.